A tariff, tariff, tariffs, a tariff, tariffs. President Trump's trade war with American allies, the third largest trading partner in the world. President Trump's tariffs are causing harm to American families and causing harm to American businesses. Empty parking lots stretch where packed shopping centers once thrived. Factory gates locked shut in the middle of production shifts. Corporate boardrooms where CEOs stare at charts showing their biggest markets slipping away like sand through fingers. Canada just signed trade deals with 11 nations that don't include the United States. 7 major American brands are about to feel the earthquake. If the thread snaps between America's closest neighbor, it won't just be headlines. It will be home. How close is the edge? The domino that started it all. Picture this: conference room in Ottawa, winter light streaming through frost-covered windows. Trade ministers from 11 countries shake hands while American representatives wait in separate rooms down the hall, uninvited. This isn't just diplomatic theater. It's this economic warfare disguised as handshakes. Canada, America's largest trading partner, has quietly been building something the US never saw coming. While Washington focused on China and Europe, our northern neighbor was weaving a web of partnerships that could choke American supply chains at their most vulnerable points. The neighbors tell the story that headlines won't. $780 billion in annual trade bet, between the US and Canada. That's more than America trades with China, more than with Mexico, more than with the entire European Union combined. But here's where it gets worse. These 11 new partnerships aren't random, they're strategic. Each one targets a sector where American brands have grown fat and comfortable, assuming Canada would always be there, always reliable, always secondary to American interests. Tech countries: Australia, New Zealand, Singapore, South Korea, Japan, Vietnam, India, Brazil, Norway, Switzerland, and the United Kingdom. Notice something? Every single one has what Canada needs. Every single one wants what Canada has. And now, American companies that built their entire northern strategies around guaranteed Canadian access are staring at locked doors. The retail giant low sign gets grip. Walk through any major retail chain's distribution center along the US-Canada border. Massive warehouses, conveyor belts stretching for miles, trucks lined up like dominoes waiting to cross into Canadian markets. One retail giant, in particular, built its entire expansion strategy around Canadian answers. 47 distribution centers, 18,000 employees, whose jobs depend on moving American goods north. The company's Canadian revenue, $847 million annually. That's not pocket change. That's the difference between growth and stagnation for a company already fighting e-commerce giants and changing consumer habits. Canada's new partnerships are about to flip the script entirely. South Korean electronics manufacturers can now ship directly to Canadian retailers without American middlemen. Bypass US distribution networks entirely. Australian food products skip American ports and processing facilities. The retail giant's advantage gone overnight. Internal memos, leaked from corporate headquarters, paint a grim picture. Canadian market penetration down 23% in preliminary projections. Distribution center consolidation under emergency review. Layoff protocols being prepared for northern facilities. It's in speculation. This is happening right now. The company's stock dropped 8% the day Canada's trade announcements went public. Wall Street analysts are calling it the beginning of a fundamental restructuring of North American retail dynamics. But then the real damage isn't just lost sales, it's lost infrastructure. When you build an entire supply chain around one relationship and that relationship of fracksters, you don't just lose revenue, you lose the machinery that generates revenue. How do you retool 47 distribution centers? How do you retrain 18,000 employees for markets you've never prepared for? The auto parts empire facing gridlock. Detroit used to mean something. Assembly lines roaring. Workers streaming through factory gates. The heartbeat of American manufacturing pounding out cars that conquered the world.
One auto parts manufacturer members.
That legacy. Their components sit in vehicles across North America. Canadian automotive plants depend on their precision-engineered parts, like clockwork depends on springs. $1.2 billion in annual Canadian sales, 38 manufacturing facilities optimized for Canadian demand, supply chains calibrated down to the hour for just-in-time delivery across the border. Now picture those assembly lines stuttering to a halt. Canada's new partnerships include South Korea and Japan, two nations that manufacture auto parts with the same precision, often at lower costs. And now, with preferential trade status that American companies no longer enjoy. The mathematics are brutal. Canadian auto manufacturer can now source brake systems from South Korea with a 15% tariff advantage over American suppliers. Engine components from Japan arrive with regulatory fast-tracking that American parts must navigate through slower channels. Others the deeper cut. The auto parts giant didn't just build factories for Canadian sales. They built their entire North American strategy around integrated production. Components manufactured in Michigan get shipped to Ontario for assembly, then returned to the US as finished systems. That integration, it's about to become alienability. Canadian facilities are already receiving inquiries from South Korean parts manufacturers about joint ventures. Japanese companies are touring Canadian factories, measuring floor space, calculating shipping distances. Industry insiders whisper about the great reshuffling, fundamental realignment of North American automotive lead chains that could leave American manufacturers isolated from their largest integrated partner. The Auto Parts Empire's CEO called an emergency board meeting last Tuesday. The agenda had one item: strategic response to Canadian market disruption. Stock analysts are calling it an existential crisis, disguised as a trade dispute. And now, the agricultural giant watching harvests slip away. Amber waves of grain stretching to the horizon, massive combines cutting through wheat fields under endless prairie skies. Grain elevators towering over small towns like steel cathedrals. This is the image of American agriculture. And one agricultural giant has built an imperium moving that grain north. Canada imports $2.3 billion worth of American agricultural products annually. Wheat, corn, soybeans, processed foods. A river of agricultural wealth flowing across the 49th parallel. The agricultural giant controls 31% of that flow. Their grain terminals, the northern border. Their processing facilities turn American harvests into products Canadian families depend on. But Canada's new partnerships are about to turn that river into a trickle. Australia and Brazil, two agricultural superpowers, now have preferred access to Canadian markets. Their wheat competes directly with American grain. Their soybeans undercut American exports. Their processed foods bypass American facilities entirely. The numbers are staggering. Australian wheat can now enter Canada with a 12% price advantage over American grain. Brazilian soybeans qualify for expedited processing that American products must wait weeks to receive. But here's where the dominoes really start falling. Agricultural giants' infrastructure depends on volume. K-grain elevators need constant flow to stay profitable. Processing facilities require steady supply streams to maintain efficiency. When Canadian demand drops, the entire system begins to collapse, backward through the American agricultural heartland. Farmers in North Dakota, Minnesota, Montana, states where Canadian sales represent 40 to 60% of agricultural export revenue, are watching commodity prices plummet as their largest market explores alternatives. Small towns that depend on agricultural presses are seeing their biggest employers calculate whether facilities remain viable with reduced Canadian demand. The agricultural giant's quarterly report buried a devastating projection in technical language. Anticipated volume reductions in Canadian markets may necessitate facility consolidation and workforce optimization across northern operations. Translation: plant closures, layoffs, the slow strangulation of rural economies built around feeding Canada. Industry analysts are calling it the new Dust Bowl, not caused by drought, but by diplomatic drought. How deep does this wound go? The energy corporation losing its northern lifeline? Oil dirks pumping against sunset skies? Refineries sprawling like industrial cities? Pipelines stretching across continents carrying the liquid energy that powers modern life? American energy independence has been a political rallying cry for decades. But one energy corporation built its empire on a different strategy: energy interdependence with Canada. The company's Canadian operations generate $3.4 billion. Annually, their pipelines carry Canadian crude to American refinance. Their processing facilities turned Canadian natural gas into products that heat American homes. It seemed like a perfect marriage. Canada had resources. America had refinement capacity and distribution networks. The marriage is heading for divorce. Court. Canada's new partnerships include Norway, a nation that rivals Canada in energy exports, and the United Kingdom, which offers advanced energy technologies and alternative distribution networks. But the real threat comes from an unexpected source: Australia. Australian energy company Uzari offering Canada something American corporations never considered: partnership instead of dependency. While American energy companies extracted Canadian resources for processing in American facilities are proposing joint ventures that keep value-added processing in Canada while providing access to Asian energy markets. The mathematics are devastating for the American energy giant. Canadian crude that once flowed south through their pipelines is being redirected to new refineries built with Australian investment. Natural gas that powered American facilities is fueling Canadian industrial expansion with Norwegian technology. Internal company projections paint a stark picture. Canadian crude access reduced by estimated 34% over 18-month period. Refinery capacity utilization dropping to 67% of optimal levels. Pipeline revenue shortfalls requiring emergency capital restructuring. But then the second wave hits. The energy corporation's entire pricing strategy depended on Canadian supply stability. Without guaranteed access to Canadian resources, their refineries can't compete with facilities that have secured alternative supply chains. Stock prices have dropped 15% since Canada's trade announcements. Energy analysts are calling it the beginning of North American energy market fragmentation. The CEO issued a statement that tried to sound confident. We remain optimistic about long-term partnership opportunities with all North American allies. Industry insiders read it differently. Desperation disguised as diplomacy. Where does the bleeding stop? Canadian pension funds are exploring direct investment partnerships with Australian superannuation funds. Canadian insurance companies are testing European risk management systems. Canadian investment firms are building relationships with Asian capital markets that completely bypass American financial intermediaries. Banking analysts are calling it the balkanization of North American finance. The company's stock performance tells the story in numbers. A 12% decline since Canada's partnership in sense with volatility suggesting investors can't calculate the true scope of potential losses. CEO Stadamensen phase confidence in long-term North American financial integration, Butte Industry Insiders. Note increased lobbying expenditures focused on maintaining critical financial infrastructure relationships. Translation: panic disguised as public relations. How do you rebuild a financial empire when your clients discover they don't need you anymore? The cascading crisis when dominoes fall together. Picture a map of North America lit up like a circuit board. Trade routes glowing like arteries carrying the lifeblood of continental commerce. Supply chains pulsing with the rhythm of integrated economies. Now, watch the lights begin to flicker and fail. This isn't just about 7 American brands losing Canadian market share. This is about the systematic dismantling of economic integration that took 70 years to build. When the retail giant consolidates distribution centers, those facilities don't just disappear, they take construction jobs, trucking jobs, warehouse jobs with them. Local restaurants that fed workers close their doors. Gas stations that fueled delivery trucks see revenue plummet. When Thudo parts manufacturer loses Canadian contracts, the effects ripple backward through the entire automotive supply chain. Steel suppliers in Pennsylvania see orders drop. Rubber manufacturers in Ohio calculate facility closures. Electronic suppliers in Texas watch their largest contracts evaporate. The mathematical model is elegant in its brutality. Every dollar lost in direct Canadian sales removes approximately $2.40 from the broader American economy through multiplier effects. 11.2 billion direct losses from these 7 brands alone. But the actual economic impact, conservative estimates suggest $26.9 billion in total economic activity at risk. But then the second-order effects begin accelerating. American communities that built their identities around Canadian trade are facing existential questions. Border towns where 60% of local revenue depended on cross-commerce are watching their economic foundations crumble. Grand Forks, North Dakota, Bellingham, Washington, Cal, Maine, Buffalo, New York, cities whose entire economic ecosystems evolved around serving as gateways to Canadian markets. When those gateways close, what happens to the communities that built their lives around keeping them open? Local banks that specialized in financing Canadian trade operations, insurance companies that understood cross-border risk management, logistics firms that perfected the art of navigating dual regulatory systems. Their expertise becomes worth less of earneth. But the human cost cuts deepest of all. Manufacturing workers who spent decades mastering Canadian specifications find their skills obsolete. Sales representatives who built careers on Canadian relationships watch their client lists become valueless. Engineers who design systems for integrated North American production discover their knowledge has no market. These aren't just job losses. These are career endings. These are communities watching their reason for existence disappear like smoke. In Winter Wind, labor analysts are calling it the great displacement of North American integration. How do you retool an entire workforce for an economy that no longer exists? Segment 10. The geopolitical chessbows, who benefits from American loss. World maps spread across conference tables and capitals from Canberra to Tokyo. Trade ministers calculating advantages. Economic stratists moving pieces on a board where continents become game squares. Canada's 11 new partnerships weren't chosen randomly, which represents a calculated move in a larger game where American economic dominance is being systematically challenged. Australia gains access to North American resources without American intermediaries. Japan secures energy supplies that bypass American-controlled distribution networks. South Korea opens automotive wire kits that were previously dominated by American-Canadian integration. But the real winners might be the nations that never signed partnership agreements at all. China watching from the sidelines as North American economist integration fractures. Russia observing as energy partnerships that exclude them crumble from within. European Union nations calculating how Canadian partnerships with individual member countries might create opportunities for broader continental trade realignment. The geopolitical implications extend far beyond commerce. When economic partnerships shift, security relations follow. When trade routes change, diplomatic alliances adjust. NATO strategies built around North American unity face questions when North American economies begin diverging. NORAD agreements designed for continental defense encounter complications when continental economics fragment. Intelligence analysts are calling it the quiet restructuring of Western alliance economics. But Harris' deeper strategic threat, American global influence, has always depended on economic integration with allied nations. When those allies discover they can prosper without American intermediation, the foundation of American international leadership begins eroding. Canadian partnerships with 11 nations create precedents that other American allies might follow. If Canada can build prosperity through diversified partners that minimize American dependence, what stops Mexico from exploring similar strategies? What prevents European allies from reducing their reliance on American financial networks? Domino effects extend far beyond North American borders. Brazilian agricultural exports that once compete with American products in Canadian markets now enjoy preferential access. Indian technology services that battled American firms for Canadian contracts suddenly hold regulatory advantages. Norwegian energy companies that struggled against American corporations operate with government backing that American firms lack. Global trade analysts are calling it the multipolar realignment of resource flows. American economic dominance, built on hub-and-spoke relationships where all major trade flowed through American networks, is being replaced by mesh networks, where nations connect directly with each other. The question isn't whether this realignment will continue. The question is how fast it accelerates. 11:11. The clock is ticking. Timeline of collapse. January 2025. Canada announced preliminary partnership framework with 11 nations. American stock markets experience minor volatility. Trade publications note potential long-term implications. March 2025. First formal partnership agreements signed. Canadian import preferences begin shifting toward new partners. American companies rep preliminary market adjustments. June 2025. Infrastructure investments announced. Australian mining equipment orders increased 340% in Canadian markets. Industrial machinery exports drop 18%. September 2025. Supply chain reconfigurations accelerate. Canadian manufacturing facilities begin sourcing critical components from Asian partners. American suppliers lose contracts worth $847 million. December 2025, full partnership implementations begin. Canadian energy ports from Norway increase 67%. American energy exports to Canada decline to lowest levels since 1987. But this timeline assumes gradual change. What if the acceleration continues? Financial models suggest a tipping point scenario where gradual shifts become rapid collapses. When Canadian businesses discover that non-American alternatives offer better terms, switching costs become negligible and competitive advantages compound rapidly. Economic historians point to similar inflection points. The decline of British trade dominance in the early 20th century, the collapse of Soviet economic integration in the 1990s, the restructuring of European trade relationships after World War II. In each case, changes that seemed gradual suddenly accelerated beyond anyone's ability to control or reverse them. The timeline for American-Canadian economic integration took 7 decades to build. How long will it take to unravel? Industry analysts are calling it the compression of economic history. Changes that should take generations happening in presidential terms. Early warning indicators are already flashing read across multiple sectors. Cross-border investment flows down 23% year over year. Currency exchange volumes declining at accelerating rates. Port traffic at northern border crossings showing persistent decreases. But the most ominous indicator might be the quietest. Canadian business schools are expanding their Asian trade programs while reducing emphasis on American market strategies. When the next generation of Canadian business leaders trains for a world where America is optional rather than essential, how do American companies compete for partnerships their competitors consider obsolete? The clock isn't just ticking, it's accelerating. The edge of tomorrow. Empty factories, casting long shadows across. Industrial valleys. Corporate headquarters where executives stare at maps that no longer match their business strategies. Workers walking through plant gates wondering if they'll still have jobs to return to tomorrow. This is the America that 7 major brands are discovering, an America where proximity doesn't guarantee priority. Historical relationships can't compete with better offers. Where being Canadian neighbor doesn't ensure you'll always be Canada's preferred partner. The thread that bound North American economies together for 7 decades is fraying, not breaking. Dramatically, but unraveling quietly, steadily, inevitably. Each lost contract weakens the weave. Each alternative partnership creates precedent for the next one. Each successful non-American trade relationship demonstrates that Canadian prosperity doesn't require American intervention. The mathematics are unforgiving. $11.2 billion in direct American losses from these 7 brands alone. $26.9 billion in total economists' impact. Hundreds of thousands of American jobs at risk. Entire communities facing obsolescence. But the human cost cuts deeper than mathematics can measure. Families in Detroit watching automotive plants calculate whether Canadian contracts justify continued operations. Workers in North Dakota seeing agricultural processing facilities close. As Canadian demand evaporates, employees in Texas discovering that their expertise in Canadian energy markets has no alternative applications. These aren't just economic statistics. These are American dreams encountering a new reality where being the best neighbor doesn't guarantee being the chosen partner. The question hanging in corporate boardrooms and factory break rooms across America isn't whether this trend will continue. The question is how fast it accelerates and how fair it spreads. If Canada can build prosperity through partnerships that minimize American dependence, what stops other allies from following the same blueprint? What prevents Mexico from exploring similar diversification strays? What keeps European partners from reducing their reliance on American networks? The dominoes are lined to pre-cross the global economy. Canada just pushed the first one. How close are we to the edge? Because if America loses its closest neighbor, it's not just a diplomatic failure. It's not just an economic adjustment. It's a generational transference of what American leadership means in a world where being American is no longer enough. The threat is fraying. The question is whether anyone can stop it from snapping completely. And if it does snap, what happens? To the America that 7 major brands represent? What happens to the workers who built their lives around relationships that no longer exist? What happens to communities whose reason for being just discovered they're no longer needed? The edge is closer than anyone wants to admit. How close are we willing to go before we find out what's on theater?